Protected and targeted highs and lows is a very important concept that we've now gone over. But once you've dug into the concept, you start to ask yourself, I understand the concept. I know that if a high is unsuccessful in taking out a low, that high is therefore targeted and will be run, and vice versa with lows to highs. But it's all well and good in hindsight, but when you're in the thick of it, when you're watching each candle tick by, often you can say to yourself, I don't fully understand or know how I can set myself up so that I can have a strong indication of what is targeted and what is protected. So what we're going to be doing is talking about a refinement to be able to better understand and better predict when a particular bit of structure is going to be protected or targeted. We're going to be using more of the concepts that we've already discussed throughout the entire Refine series. So what we're going to be doing is looking at protected and targeted highs and lows using liquidity as a refinement. So what we can do is we'll just look at very basically, and what we'll do is we'll just look at a simple liquidity grab type protected low that is happening here in the market. So what we can see is the market's coming down, we pull back up, we pull down. So if we're just looking at it from a market structure perspective, we have a high, we have a lower low, we have a lower high, and we have a lower low. We then break to the upside, creating a higher high, which we know this bit of price action is known as a change of character because we're switching from bearish to bullish. But what we can also see is that from a liquidity standpoint, this low right here, a lot of liquidity was sitting below here. When price came to the downside, creating that lower low, which is following trend, it took all the liquidity that was there. And what we would expect as the next logical step, if a bear trend was to continue, is that we would form some sort of lower high and then continue pushing to the downside. But as we can see, what ends up happening is we actually move to the upside, creating a higher high. We get that change of character and price begins running off to the upside. Now, if we're looking at this in the context of protected or targeted highs and lows, what we can see is we're putting together all of the pieces now. So what we can say is this low was successful in taking out this high. Therefore, this low should be considered protected. And we can take that a step further by knowing that this low took out this structural liquidity and then took out this bit of structure. So when we're looking at a protected low, for an example, we need to see two things. We need to see the low actually taking out the previous high, which is what we discussed in the market structure section when we explained what a protected low was. And what we need to see more specifically is liquidity being taken. Now, this can be in the form of structural liquidity. This can be in the form of equal lows liquidity, any form of liquidity. But at the end of the day, what needs to happen is we need to see that flow or that transactional flow of switching hands from, in this case, bearish to bullish, from supply to demand. And what we can see is once we've taken liquidity, created a low, our next expectation when we're just looking at price action initially is that price would create a lower high and continue to the downside if we are to remain bearish. Now, of course, what we can see is that price doesn't do that. We create that higher high. Now, we compare this with a few other things in that this protected low can often mitigate something or take out even more liquidity before it is created. Those are two other criteria. And we know if we are to see structurally in this case, a higher low to be forming, we would be looking for price to tap into, say, a demand zone or take out liquidity or both. And in this case, then we would see something like this, and then that would give us our point of interest. We've cleared out all the internal range liquidity, and then we've continued moving to the upside. And you can see how all these pieces start to build together by just looking at a very simple price action pattern that we're looking at. And it's this level of detail that we really need to look into when we are looking at this, because yes, we can get this small little model, but we need to take it a step further and look at it from that lens. So again, the basic premise is that we are seeing some sort of downtrend. It can be an extended downtrend where price is continuously making lower lows and lower highs. And at some point we start to build liquidity. We take that liquidity, and if we were to continue seeing bearish movements, we would see a lower high being created followed by a lower low, which would then break the previous lower low and price would continue down. But once we start to see trend shifting and we break that high, we can denote that as a protected low. But now you're probably asking yourself, yes, now this makes a little bit more sense and how I can refine a protected low. But what am I supposed to do? How am I supposed to predict whether it's going to happen? Well, At this point, there really is no way to predict whether or not a high or low is going to be protected or targeted to a certain level of certainty. But what this does allow us to do is when we're planning trades, once we've actually created the protected low in this case, what this does is, if we go back to the supply and demand zone refinements, is we've taken liquidity. Chances are this is going to be a very valuable point of interest or demand zone that we could look to be trading. Not only have we taken liquidity and broken structure, if we have something like this where we create a demand zone, we take out liquidity, we break structure, and we've mitigated that demand zone, we now have an incredibly high probability that a demand zone is going to be respected. And not only that, because we know it's a protected low, we also know that the likelihood of price breaking below this particular low is significantly reduced because it is protected by nature. And then on the flip side, we can just look at the protected highs and the targeted lows. So what we can see on the flip side is that we're creating higher highs and higher lows. We have structural liquidity resting above this previous higher high after we formed this high. If we were expecting to see an uptrend continue, we would expect price to form some sort of higher low and then price to move to the upside, which would then form our higher high. But in this case, what we end up seeing is price moving to the downside, creating a lower low. This lower low creates a change of character, and we're switching from bullish to bearish price action. Now, again, what we can more than likely see as well is that price could create something like this, where we have a lot more internal range liquidity, we mitigate some sort of supply zone, and then we create that protected high and then continue to the downside, which would then form a new point of interest. And like I spoke about in the previous supply example, we have a mitigation of a supply zone, we have a break of structure, we have liquidity being taken. So what we know is that this supply zone is incredibly high probability. We factor in the fact that we know that this high is more than likely going to be protected because a lot of momentum has been entered at this particular point in the markets. So from that perspective, price has no real reason to move to the upside initially. Yeah, of course, now we can argue that we're starting to create equal highs and that price could eventually at some point move to the upside, but from a mitigation standpoint, price is more than likely going to tap into the supply zone and continue moving in that otherwise downward trend based on the order flow that is being presented. And again, we can look at this example as well, where we have equal highs. We take the liquidity of those equal highs, we create a new higher high, and then what we end up doing is we break to the downside, breaking structure, breaking the last recent structural point, this higher low, and we move to the downside, creating a lower low. We see the change of character from bullish to bearish. And again, like the other crudely drawn examples that I've done, we have a potential supply zone that we're tapping into. We've taken liquidity, we've broken structure. We now have the workings of a very high quality, protected high supply zone that is being created, which gives us a lot of indication that this is going to be a really great opportunity to look for potential sells. And even if we don't get a tap into this area and we're starting to see price respecting, and we know realistically that price is not going to come above this high, so looking for trades at these levels is a very good high probability area to look at. So again, the most important thing when looking at protected and targeted highs and lows is understanding that when we take liquidity, when we break that structure, we get that change of character, we can begin to say that price action has created protected and targeted pieces of structure. And if we look at the bullish example, we can see that once we take the liquidity and break the previous swing point, which is the lower high, creating a higher high, we now have the workings of a protected low. Now, the protected low can be used of one of two things. We can use this as a potential point of interest or demand zone to look for entries, or what we can do is simply just know that as price is continuing on, that realistically, unless we tap into a supply zone that's created by some sort of other protected structural point, price will not need to break this bit of structure. So we can have a little bit of certainty that this is more than likely the lowest point the price is willing to go in this particular circumstance. But of course, as more candles are being printed, as more price action is happening throughout the market, this is going to change. And one other thing to note as well is you also have to begin to understand your time frames. If you look at a 15-minute protected low, for instance, is that going to be more powerful than a 4-hour protected high? No, of course not. So we need to be able to understand how fractal price action is and how all of these work together, and how price action on the 15-minute is building that 4-hour price action, and how we can have protected lows on a 15-minute chart but still be bearish on the 4-hour and have a protected high on that 4-hour chart, and how we can see that 15-minute shifting from bullish to bearish and then everything aligning so that we can then look for bearish continuation trades that are in line with the higher time frame. And then finally, we'll just recap the supply zone as well. Again, we have liquidity that rests above this previous higher high. We take that liquidity, forming a new higher high. We break that swing point, create that change of character, and then price continues moving to the downside. We can say that this is now a protected high and that price has no reason to return above this point now that we've seen that change of character, now that we've seen that liquidity grab. And again, we can either use that as a high probability area to look for supply and look for trades, or just understand that price in its current state has no real discernible reason to move to the upside above that swing point, unless of course there are protected lows on a higher time frame or order flow is beginning to shift. It all becomes down to, yes, we may have these points, but then where are we starting to react off of? Because just because a point is created, and I just want to emphasize this point, and just because a protected high is created, for instance, doesn't mean that it's not going to break at all and that there's no chance of it. If, say, this is the 15-minute chart, we're seeing that protected high being created, but let's just say below here is a 4-hour demand zone, so we know that we're already looking at higher time frame points of interest versus 15-minute, then we could see is what does price action start to give us? If we start to see a protected low being formed within that, say on the 15-minute, reacting off of that 4-hour demand zone, and we start to see price action shifting, we start to see bullish order flow or the demand chain starting, we're starting to see mitigations of demand and prices continue moving to the upside, that might mean that things are changing and that this protected high on the 15-minute is now going to be some form of external range liquidity that we can look to target when we're looking to buy down at the 4-hour point of interest.